I'm Teresa Matic with the Investing News Network. Here with me today is Frank Holmes, CEO and Chief Investment Officer for U.S. Global Investors. Frank, thank you for joining me today.
It's good to be here.
Great. So we're coming up on halfway through the year. Has gold performed as you'd expected, and were there any surprises for you?
Not really. It's gold had a bit of a run and sort of rolled over. It has a lot to do with the dollar right now. And I think in the second half of the year, normally gold is a better performer because we go into that other component of demand is the love trade.
And what needs to happen exactly to push gold prices up?
What would push them up? I think a catalyst globally would be China. China is looking to become part of a global currency, and they need to have gold to back it. So they're with the IMF for special drawing rights, is the technical word, so that their currency is a tradable, fungible for commodities, for stocks, for anything you want to do around the world. And right now we have the British pound, we have the euro, the Japanese yen, and the dollar, and they want to be positioned as another player at the table. I think that will be an event that's important for global gold prices.
Okay, and one other important thing that investors are watching is a potential rate hike from the U.S. Federal Reserve. So when will a rate hike come, and what can investors do to prepare?
Well, I think that if you have a long, what do they call it, long end portfolio in bonds, if you have 10-year and 15-year bonds, you should shrink them down to 3 and 4 years, I think, as an investor. But otherwise, I really don't think rates are going to rise very much because the dollar gets much stronger, like it was last year. Since it had this huge run, it's had a huge negative impact on industrial production. So we've now seen 5 months in a row of industrial production declining. We're seeing the PMI, the Purchasing Manufacturers Forward-Looking Index is important. It's now turning negative. These are factors that if raising interest rates makes the dollar much stronger, America can't export anything. So I don't think it's really going to happen.
Right, okay. And shifting gears a little bit, I want to ask if you could comment on Sprott Asset Management's intended bid for the Central Gold Trust and Silver Bullion Trust.
Well, Sprott is on a predatory model of trying to acquire things opportunistically, and that's what they're out to do. And I think that for investors in the U.S., that it's less expensive to just keep your central fund shares. The Spicer family are very frugal. They live in Ancaster. They're very ethically honest, straight up people. So I think if someone was to switch over from one event to the other, I think then there's a possible tax implication for it. It's cheaper to keep the Central Fund of Canada. So as an investor, I will just keep the Central Fund of Canada. But we'll see how that plays in the market.
Okay, and more broadly, investors are still waiting for a change in the markets. Should they stop waiting, and is this the new status quo?
Yeah, it's in a pause stage, the threat of rising interest rates. And also don't forget, I mentioned to you industrial production has been declining, and so have earnings. So a lot of analysts forecasted last quarter's earnings to be minus 3%. They came in plus 2%, nothing compared to last year, which is much more robust. I think that in the capital markets, that dividend-paying stocks are a very, very important part of the portfolio. When you look at the S&P 500 now, 85% are paying dividends and increasing them. And for the past 5 years, we have seen dividends increase every quarter. So you know this past quarter, what dividends went up? They went up 15%. And we're also witnessing where management are better stewards of capital. If they can't go and get that higher return on capital, they're buying back their stock. They're increasing the dividend. So management's interests are more aligned with us as investors. So I think that when we look at government bonds, why would you go and buy a U.S. government bond paying 1.4% when you can buy the blue chip stocks paying 2% and growing their dividends at 15%? So I think that stocks are still the place to be, and I don't think rates, if they go up, would be temporary for them. The dollar would scream, and then all exports would decline. So I don't think it's going to happen. Bet on U.S. stocks, good quality companies.
Okay, that's interesting. And finally, you obviously talk about gold a lot, so I wanted to ask, what's your favorite deal so far this year in terms of gold companies?
Of gold companies? We follow 88 global gold producers, and one has to apply Pareto's law, the 80-20 rule. And it's only about 20% of those 80 some odd companies are great CEOs. And so now we've got it down to 16 to 14 as a number. So I think investors have to focus on those types of companies where they're great stewards of capital. And the junior ones, is Klondex is a big holding. The CEO is very much a frugal person and how he runs a business. So I think that shows up in higher returns of capital, increase of production. The royalty companies, I always love the royalty companies because they have a competitive advantage with that superior model. So the Franco, Nevada, local here, Silver Wheaton, and Royal Gold, I think are key to your portfolio. Cisco is a new one on the block. I think that these are great companies for any investor.
Great. Thank you so much for joining me today, Frank.
Great to be here.
I'm Teresa Matic with the Investing News Network.